Does the long term always win? A research-based examination of long-term investing. The phrase, long term always makes money, is one of the most repeated beliefs in investing. But is it universally true? The short answer, often, but not always. Context matters. 1. What history suggests. Looking at broad equity markets, like the S&P 500, long holding periods have historically increased the probability of positive returns. Key observations from historical data. 1-year returns, highly volatile. 5-year returns, more stable. 15 to 20-year periods, historically positive in most rolling periods. Compounding works best when time absorbs volatility. However, this applies primarily to diversified indexes, large economies, stable institutional systems. Not every market shares this outcome. 2. The survivorship bias problem. When people say, long term always wins, they often reference successful markets like the United States. But consider, Japan's Nikkei 225 peaked in 1989 and took decades to recover. Some countries have experienced prolonged stagnation or structural decline. Individual companies can permanently fail, even industry leaders. Long-term investing reduces risk. It does not eliminate it. 3. Time reduces volatility, not fundamental risk. Research in behavioral finance, notably by Daniel Kahneman, shows that short-term fluctuations feel more painful. Longer horizons reduce emotional decision-making. Investors staying invested avoid costly timing mistakes. But time alone does not fix overvaluation, poor business models, structural economic decline. Time helps good assets compound. It does not rescue bad ones. 4. The role of diversification. Long-term success is strongly linked to broad diversification, low costs, reinvestment discipline. For example, diversified index investing, popularized by John C. Bogle, relies on market growth over decades, cost minimization, staying invested during downturns. In this framework, long-term has historically been favorable. 5. When long-term fails. Long-term investing may disappoint when you buy at extreme bubbles. You invest in a single stock. You ignore valuation completely. You need liquidity during downturns. Structural regime shifts occur. Time horizon must align with risk tolerance, asset type, personal financial needs. Core insight. Claim. Long-term guarantees profit volatility disappears. All assets recover. Diversified markets tend to recover. Time rewards discipline. Reality. No guarantee. Volatility decreases, not necessarily historically, yes, strongly supported. Conclusion. Long-term always wins is not a law of nature. A more accurate statement would be, long-term investing in diversified, productive assets has historically increased the probability of positive outcomes, but it does not eliminate risk. Time is powerful, but quality, valuation, diversification, and discipline determine whether time works for you.